Thank you for the opportunity to speak at this conference on the importance of professional standards, particularly from the perspective of consumer confidence. What I'm going to do over the next 20 plus minutes or so is maybe position this topic from the perspective, first of all, of a macro level consideration as to the importance of professional standards and the influence that they can bring to bear in terms of macro considerations, so not quite a macroeconomic perspective, but maybe macro societal perspective. And then sharing with you the reality of research that we have as to the importance that professional standards make from a consumer perspective initially, but also then sharing with you what that means from the perspective of financial planning professionals themselves. I should qualify that the research I'm sharing with you is from the perspective of the CFP designation itself. And I'm aware that many of you in the audience will already be CFP professionals. Nonetheless, I would feel strongly that the message contained within this research would apply equally to investment advisors and the whole issue of professional designations and individuals who apply to their practices standards that are recognized as benefiting consumers at large. Just a very quick word, if I could, on the scale of the CFP designation, because it matters for the purpose of sharing the research. At the moment, there are almost 240,000 CFP professionals practicing across 29 territories internationally. Recognizing that India is one of the most important of those territories, it is one of our fastest growing territories, and indeed we work very closely directly with the team in India, particularly with Chandra and Anshul, who many of you I suspect will know. And just recognizing that for the future, FPSB internationally sees FPSB India as a major part or region of our portfolio of affiliates, and is an area where we see the opportunity to develop a center of excellence that can be influential in the development of standards internationally and beyond the borders of India. Before I start, I do also want to acknowledge and recognize the efforts of the ARIA team, and particularly Renu, in developing these standards for the investment advisor profession in India. FPSB International has recognized this through a letter of support that we issued to ARIA late last week. But I just want to acknowledge it is a major development from the perspective of any profession, and so for investment advisors in India, on behalf of FPSB International, we would see this as a significant development for you as a group of professionals. So what I initially want to maybe, I suppose, position this conversation around is the importance of consumer access to capital markets. The role that investment advisors, and by extension any other financial advisor, has to play in supporting that access, and by extension then into what does it matter for investment advisors and financial advisors generally themselves. So in looking at access to capital markets, there are a number of considerations, and I suppose at its heart with any particular economy is the ideal that economic development and growth is shared across society. It is not the preserve of any one aspect of society. And maintaining that access to capital markets, and in particular, I suppose, worth recognizing that we're largely at the moment talking about share markets and bond markets in particular, it requires expertise in terms of guiding consumers in how they might access those markets, but also what it is that they might expect from the perspective of participation in the market. So the expectation that the return for participation in the markets is that there is some sort of a reward that comes back, and to some extent there is some level of capital protection that is afforded to those consumers. And I think, given where we're at with world developments, wealth inequality is increasingly becoming an issue. And I think it's fair to say that capital markets can have a role to play, or access to capital markets can have a role to play in perhaps adjusting some of that wealth inequality on a more equitable basis across the various strands of society. And maybe lastly, just to acknowledge that what it allows from an economic perspective for a territory is, I suppose, providing various different sources or access to various sources of capital for industry within those economies. And so it reduces to some extent reliance on outside or foreign direct investment. So it's an important principle, I think, to start with. Is it matters that consumers are provided with access to capital markets, and it matters that they share in the rewards of participation in capital markets. Having said that, it does present its own challenges. There is volumes of research on this particular issue of individual individual consumers having access to investment markets and demonstrably underperforming what it is that the markets return. There is one particular piece of research that I go back to on an annual basis, and it was central to some of my lecturing back in the day. Is a piece of research run by an organization called Dalbar in the US. And the latest research that they disclosed, which is for the year 2024, illustrated that the average investor in the US had a return from the stock market of 16.5%, as against a performance of the S&P of 25%. So there's an 8 percentage points lost through the behavior and decision making of the individual investor as against the performance of the market in general. And there's a couple of things just maybe to reflect on when one recognizes that particular issue. If that issue persists, there is another side to this equation, which is the 8 percentage points are gained somewhere else in the equation. So if the average individual investor is losing out, it is going somewhere else. The capitalization on the pricing inequalities that are created through bad decision making are largely availed of through algorithmic based quick decision making mechanisms, and so the benefits of the poor decision making rest elsewhere within the investment spectrum. So worth acknowledging that, and keeping in mind that the responsibility for investment decisions is increasingly shifting to the individual themselves. And a simple example of this is the progression, particularly in Commonwealth countries, and my understanding is India certainly has this as part of its structure, but the move away from defined benefit type pension structures to defined contribution type pension structures. So that notion that I as an individual will spend my life working in industry, and when I get to my retirement, I get given a pension in the form of an annuity, is increasingly falling away to be replaced by a structure whereby I, as that individual, am given an account into which funds are deposited. Some I contribute myself, some my employer contribute, but it needs management. It needs decisions around portfolio organization. It needs decisions made in terms of the changing of that portfolio depending on stage of life considerations, etc., etc. So again, the message being that there is substantial wealth coming into the hands of individuals that are not perhaps used to managing that wealth and being asked to make key decisions. And it isn't only in the pensions space that this is happening. It exists beyond. In any growing economy, it is a feature that individuals initially start off in employed situations where the salary is allowing a reasonable standard of living. As the economy grows, so too do salaries and lifestyle expectations, but also there starts to be generated surpluses which are available for onward investment or savings under some sort of a mechanism, and whether that's savings for the purpose of purchasing a house, purchasing a car, or whatever the case might be, or whether it's savings for the purpose of investment to accumulate further wealth for further investment, to be explored with the individual. But the principle being there are surplus funds being generated for at an individual level within the economy that is available for onward investment in some fashion. The point being, it's increasingly resting in the hands of individuals that need to make these decisions, lack the financial literacy, and so therefore are at a point where they need to find some expertise and advisor that can work with them in terms of making informed decisions. The types of behaviors, sorry, I flipped too quickly there, the types of behaviors that tends to be exhibited in these types of situations, and I'm sure everyone in the audience has studied behavioral finance, but it's this notion of quick decisions or rules of thumb that are based on ingrained sort of behavioral patterns. They're oftentimes ill-judged, but come from a space of whether it's a cultural belief pattern or whether it's a belief pattern that is established through one's life and lifestyle, etc. But the point being, they are often not well enough considered. And so, to my point, we have consumers making decisions oftentimes that do not act in their best interests. There is a need, therefore, for some sort of level of professional advisors that can help consumers in the management of their finances. And ultimately, as a society, what we're trying to get to is a point where it improves individuals' sense of financial independence as they accumulate wealth, whether that's in pension structures, whether that's in property type investments, whether it's crypto finance, it matters not. The point being, there are decisions to be made as to how one would build out that level of financial independence. Again, from a society perspective, there is the important consideration of pressure on public resources. And so if that sort of ability to manage one's finances to deliver that notion of financial independence, if that fails, what it inevitably results in is increased dependence on welfare systems at a time when welfare systems in the developed world are in decline. There is significant pressure in pretty much all jurisdictions on welfare state systems, and the issue being that in the absence of an ability to manage one's finances, that I suppose support is increasingly in decline and is not as generous as perhaps it had once been in many territories. When we talk about standards, we talk about professional standards that include, for example, improving knowledge that is above and beyond the level that might be mandated by regulators as being of minimum competency. It is about setting standards of practice that recognize that the nature of the relationship between the advisor and the consumer is asymmetrical in that the individual advising has far greater knowledge than the individual receiving it. So in setting practice standards, how do they support and enable consumers to participate in the decision-making process? Underpinning all of this is, of course, some level of ethical conduct and guidance around what ethical conduct is expected of advisors. And lastly, holding individuals to account. And by that, what I mean is, if there is misbehavior on the part of financial advisors, that there is some mechanism for identifying the misbehavior and taking action against those individuals. And there's different ways that's manifest. Regulators will have a role to play in this. The court system will have a role to play in it, but there's also a role for the profession itself to have a role in identifying these individuals and removing professional recognition from them. One thing I just want to add to what's contained on the slide is it's important that professional standards are not set at a moment in time and stay there forevermore. It is vital for the profession and professional conduct that standards are reviewed and updated on a reasonably regular basis. It's difficult to update every year, but certainly there should be a cycle of revision and improvement and updating of standards. If I can give you one small example of how this has manifested itself for the CFP designation, it is that in the last round of updates, we identified through the profession itself, we identified that the profession needs to have greater emphasis on developing human behavior skills. So in other words, being able to identify patterns of behavior in consumers, understanding or being able to have the skills to understand where the individual's behavior might arise from. Again, is it back to lifestyle issues? Is it lived life experience? Is it something else? Is it a cultural expectation that might generate some of those belief systems? But it's beyond behavioral finance, and so we created a new knowledge domain that is called psychology in financial planning, and it starts to introduce some of the principles of psychology and into financial planning. I mention it just as one example. The world is moving. A lot of what we take for granted at the moment as being skills that are essential to the practice of advising clients, and I mean technical skills in particular. So whether that's doing time value of money calculations through software, through calculators or whatever, much of that will in time, I expect will come to be performed through technology supported through AI, if we include AI in that technology conversation. So just to position that. So in this sort of evolving world, what does all this mean, and what does it mean? So like one of the things from a consumer perspective, one of the issues that we grappled with for many years was the profession has always believed that its service is of great value to consumers, but we've never had the consumer's perspective as to whether it matters, and if so, to what extent and how it matters from a consumer perspective. So FPSB International conducted some research back in 2023. There were 15 countries that participated in the research, one of which was India. And the couple of findings that I'm sharing with you now relate particularly to the research that came out of India. So, as I mentioned in my opening, I'm focusing on CFP as an example. I expect these learnings will apply to the principle of having professional standards matters, irrespective of whether it's CFP or otherwise. So what this slide presents for you is how it matters to consumers. So reading down the left, it's in the areas of quality of life, financial confidence, financial satisfaction, and financial planning experience. In all of those areas, you can see that the experience of satisfaction of working with firstly working as an individual. So in other words, taking no advice from anybody. You've got a level of satisfaction measured for those. In the middle, we have those that have some advice, whether that's from accountants, from banks, from whoever it might be. And then lastly, we have the group that were clients of CFP professionals. So what we were able to identify is that there is a premium to the standards associated, in this case, with the CFP professional designation, and that it matters from a consumer perspective in terms of the positive impact that dealing with a professional that holds themselves accountable to standards and to ethical conduct has a premium. It matters in terms of how it impacts on the well-being of the financial well-being of consumers. Most importantly, in terms of measurements of trust and by extension continuity of relationship with their financial advisors. When it came to the CFP brand itself, there was very strong measures to indicate that the satisfaction levels were such that the consumers in most cases were going to continue to operate and maintain that relationship with their CFP professionals for the foreseeable future. So very strong endorsement coming from consumers in India as to the value of that particular designation, and demonstrated confidence in a reputable brand that is underpinned by professional standards and a certification process that requires adherence to those standards, but also to conducts of professional practice and ethical conduct. The second piece of research I mentioned in my opening was, okay, so it matters from a consumer perspective. What difference does it make from the perspective of the practitioner? Does it matter from a practitioner perspective, abiding by these professional standards? And if so, how is that manifest? This piece of research was conducted back in 2014, so it is a little bit dated, to be fair, and this is not unique to India. So these results are a global set of results. But of those researched, and they included large firms, so large banks, large insurance companies, investment firms, stockbrokers, and individual practitioners, all were researched at the time. These results are across the spectrum of respondents, so it's not isolated to independent advisors or independent practitioners. But what you can see is the measures are very strong in terms of the impact on a business of recruiting and having within the firm practitioners who hold themselves to a higher standard of professional conduct. And it matters across all of the key areas of generation of revenue, productivity, profit measures, etc. Not alone in those areas, but crucially in the areas of legal risk as evidenced through the levels of complaints that are received by regulators from those who have the higher level of professional standard as the benchmark against which they measure themselves when it comes to practice. So a material difference to firms in that space. So from a firm perspective, what the research gave us at the time is that there's a substantial measure of client satisfaction, which from a firm perspective, as many of you run your own business, you can attest how difficult. One of the most difficult challenges to running one's own business is the generation of clients in the first instance, and then retention of them. And it's far preferable to retain existing clients than to have to go to market to identify and recruit new clients. So that client retention aspect, very, very important. Reduced complaints and So by extension, less pressure on capital to be set aside to deal with the outcome of complaints. And we've spoken about the client retention piece already. And the final observation on this piece is that critically, in 75%, in excess of 75% of respondents, what it meant was higher levels of career advancement, and within that also higher levels of remuneration and compensation for effort that goes into managing a client base. So in summary, in terms of does it matter from the professional perspective, it does. It absolutely does. Higher levels of revenue, fewer complaints, so less strain on the expense side of the balance sheet, higher levels of satisfaction, and improved career opportunities, earning capacity, etc., and advancement into senior positions. So again, what I maybe summarize and close off with is recognize that the development of professional standards from a general society perspective matters. It matters that increasingly, as wealth is left to self-management on behalf of individuals who do not have the financial literacy to be able to do so, there needs to be confidence that there are available individuals with the expertise and the standards of conduct that will enable confidence on the behalf of consumers that they can participate and share in the spoils of capital markets. It matters in terms of quality of consumers' lives. It matters from the perspective of dealing with issues of inequality in society. And it matters from the perspective of the profession and the individual professionals themselves, in that there is a higher level of satisfaction in terms of job participation, but also a higher level of compensation and reward for working with satisfied client base that is not constantly turning over, that is retained and secures a higher share of the wallet from consumers. Finally, my final remarks are, again, just to reiterate and congratulate ARIA on this move towards developing professional standards for the RIA designation in India. We believe it's a very positive development, and congratulate the board and Renew on the work that has been done in this space. Thank you.